Hi, this is Professor Karen Lin. In this video, we're going to introduce Statement of Stockholders' Equity. Let's get started. The Statement of Stockholders' Equity reports the change in each stockholder's equity account during the period. As we mentioned before, in this chapter, we only focus on two accounts of the stockholders' equity: common stock and retained earnings. Common stock represents the amount of capital that the shareholders provided when they purchased the stock. Retained earnings, on the other hand, reflects the money that the company operates and earns during the years and remain in the company. You can see this item has two words, retained and earnings. Earnings basically means net income. Retained means the portion of net income that kept in the company. Retained means kept. So retained earnings is basically the portion of the profit that the company made, which belongs to the shareholders. That's why it's under the stockholders' equity section, and kept in the company. So you can see Statement of Stockholders' Equity reflects the changes in common stock and retained earnings. How does the retained earnings change? Retained earnings change by the beginning retained earnings, which means all the retained earnings the company has up to the beginning of the year, plus the net income, which means the profit that the company made in the current year, subtracting the dividends. Dividends are the returns that the company pay back to the shareholders. So basically, retained earnings equals to last year's retained earnings plus the net income minus the dividend. So this ending retained earnings will be reported in the balance sheet. You can also see stockholders' equity statement is basically the linkage between the income statement and the balance sheet. We talked about it in the previous two lectures or the videos that balance sheet reflects a snapshot, which means at the end of the year, on December 31st, 2020, the company has all cumulated retained earnings 64.0 million. So this means starting from day one that this company established up to the reporting date, which is December 31st, 2020, the company has accumulated $64 million of profits that hasn't been distributed to the shareholders and belong to the shareholders and kept in the company. Now, why do company keep earnings? The company wants to reinvest, or the company would keep this part of resources for future development. And how do we know the retained earnings? It's from all previous years' net income added up, subtracting the dividends. So as I mentioned, we are only going to be focusing on common stock and retained earnings in this chapter. If you don't understand retained earnings for now, it's fine. It's a very difficult sort of concept for any beginners of accounting. But as we go along during the course, you will understand the term better and better. But in this video, I'm just trying to explain the mechanism of the stockholders' equity. So first of all, the change of common stock. Again, common stock are the amount of money that invested by the shareholders when the business starts. So common stock could change if a company issue new stocks. So the beginning common stock, which means the common stock we have last year, plus any newly issued stocks would equal to the ending common stock. Retained earnings, as I explained, would be the beginning retained earnings. Beginning means at the end of last year or at the beginning of this year. So last year's retained earnings plus this year's net income, subtracting this year's distribution, which is termed as dividend. Beginning retained earnings plus net income minus dividend equals to ending retained earnings. Here is an example. For Lenature's Statement of Stockholders' Equity is for the year ended December 31st, 2020 in millions. Common stock at the beginning, this is beginning, which is the balance on December 31st, 2019. That is the beginning of 2020. So beginning balance of common stock is 50.7 million. In the current year, there's no new issue stocks, so ending common stock is still the same. For retained earnings, the beginning retained earnings, which means the last year's number, was 43.1. For the current year, the company earned a profit of 22.9. So that would be added to the retained earnings. Remember, retained earnings means cumulated profits without distribution. So we pile up all the profits. We add all the profits up. So 2019's cumulated profits plus the profit for 2020 equals the total profit that the company made without distribution. During 2020, the shareholders decided to pay $2 million of dividend out of the net income they have produced. So they want to get $2 million as return. That will be subtracted from the retained earnings because it's distributed. When it's distributed, it's not retained, so it's subtracted. So finally, you will see, as I try to illustrate, the stockholders' equity statement is the linkage between the income statement and the balance sheet. The net income the company made will eventually flow to the balance sheet in this account called retained earnings through this equation, ending equals to beginning plus net income minus dividend. All right, I'm going to stop here, and this concludes our chapter. And I'll see you in next week and next chapter.